Hello and welcome to Owner Financing by the Numbers, where we look at what happened in 2019 and we make some projections for 2020 because, boy, have things changed. So here's what we're going to cover today. We're going to talk about key trends in seller financing over the past 10 years. Also, what are some average loan amounts and loan to values? And note creation by property type compared to residential, commercial, and land. We'll talk about what 10 states make up 69% of the volume, and also we'll compare mom and pop sellers, the people that just do one in a year, compared to seller financing pros that are doing two or more in a year. And then what's happening in 2020 and what are projections for post COVID-19 note investing. Now, this is the numbers at a glance, and we've been tracking these. I've been in this note business for 30 years now. We've been tracking them in different varieties since I've been in the business, but we've really gotten a little more sophisticated about it over the last 10 years as more counties came online that were recording and reporting the data. So at a glance, in 2019, the seller financing trends were 23.9 billion, yes, with a B, seller carry notes were created when you look at dollar volume, and that was about 86,155 by count. Now, if you follow these stats or you watched last year's video on this, that's a 7.4% decrease in the dollar volume and about a 5.95, well, let's just say 6% decrease when you look at the number of notes created by seller financing. But still, even though there was that bit of decrease, we see when we add up the last 5 years, there's over $113.8 billion in seller finance notes that were created from 2015 to 2019. So lots of inventory still out there. And when we look at the top producing states for seller financing, the top 5 are Texas, Florida, California, Arizona, and North Carolina. And later in this video, we'll talk a little bit about the other states that make up the top 10. So where do these numbers come from? Well, they come from the county recording data. They're public records where people go down and record deeds and mortgages and all of those normal things that have to do with property. But what's different about this is this where the seller of the property, the person that owned the property, was also the lender. So they gave a deed to the buyer and the buyer gave back a deed of trust or a mortgage to that seller instead of getting a bank loan. So owner financing, seller financing. So that would be where the seller who owned the property was the beneficiary on a deed of trust, the mortgagee on a mortgage, or if in your states that use contract for deeds or CFDs or land contracts, they would have been the seller on a recorded contract for deed. Now, if that wasn't recorded, obviously it couldn't be counted in these records because it needs to be part of public records. The data itself is pulled by Advanced Seller Data Services, and they are a list provider for people who are looking for lists of seller finance notes. And Scott's always kind enough to share these, and we go through them, and I like to put them into some interesting slides just to compare the numbers that we see. And this is 2,096 counties reporting out of 3,007. Now, some of the counties just aren't online for public records. They're not readily available, or perhaps the numbers were just so small it didn't make it worth the time or effort in some of those rural counties to pull all the data. And these are first position, so they don't include second liens, first position or wrap notes where the seller is still paying on their underlying. It's notes that are $30,000 or above balance. So that doesn't include, like I said, the seconds or those smaller notes. So here's a chart of looking at a decade, 10 years of seller finance usage. So we see if we go back the 10 years in 2009, that's our baseline. And that's right after the subprime lending meltdown and the real estate market crash. And we can see that lending, we all know, restricted, it pulled back. And so we saw there was a big need for seller financing. And so that increased in 2010, 11, 12, 13, 14, where it reached the apex. And then it started to come back down when the banks got back into lending more readily. And we see now it's sort of evened out there starting in 2017, 18, and I consider 2019 an evening out of that too, where it's still more than it was 2009 through 11, but we're pretty much at, well, we're about those 2011 numbers now, but down from the high. So how does it break down by property type? Well, residential transactions made up 9.23 billion or 39% of the dollar volume and 54% of the count. So definitely most of them were on residential properties. Second up was land. That was 25% based on the dollar volume of 6 billion and about 15% by the count. And then we have commercial, which is 4.34 billion, or 18% by the dollar amount, and about 12% by the count. And then if you're adding those numbers up, you're saying, hey, we haven't got to the whole number yet. And that's because there's a small amount that are unknown property types. So this means that we know they had owner financing, but the data pulled didn't specifically say if it was a residential land or commercial property type. So our history experience shows that usually it divvies up about the same, on this unknown category as the residential land and commercial. So that is sort of how, by property type, we see seller financing. Now we can go back and look at that volume, not just in 2019, which we looked at in our last chart, but also how that compared to 2018, 17, 16, and 15. So we can see when you add those totals together for each of those years, we get 113.8 billion in the past 5 years for seller finance notes that were created. Now we're going to look at average LTV and note amount. So LTV means loan to value, how much somebody owes compared to what the property is worth. And these are just the notes created newly in 2019 using owner financing. On residential properties, we see an average 80% loan to value. That means that buyer, who is also the borrower, put down about 20%. Or perhaps they took a little bit of a second back. But we saw an average 80% loan to value on those seller carried first position notes, with an average note amount of $196,926, which was up just a little bit from 2018, which makes sense because property values have been going up. For commercial, we saw an average of 74% loan to value. That means they brought even more in for down payment. The average note amount was $414,676, and that was up from 2018 as well. And then land had an average of 75% loan to value, and that average note amount was $468,500. Now see, it was much lower than in 2018, which was over $605,000 average note amount. And we mentioned, if you go back and watch those videos, that number really jumped up on land last year, and there were a lot of large land sales, multi-million-dollar land sales that came on, maybe developers that were buying and selling because the building is going on is so robust right now. We saw a lot of that really skewed the numbers last year. This year we see it more in line with what we've been seeing averages as well for land. Now this always fascinates me. You've got what we say the 80-20 rule, but in seller financing it's more like a 70-30 rule. But 69.4% of the notes created based on the count came from just 10 states. And the remaining 30.6% came from those other 40% states. So you've got a big number of seller financing attributed to just 10 states. So what are those states? Well, as usual, Texas last year, 2019, it has for many years past, was the number one producer of seller financing. They made up 23.1% when you look at the count. Florida was number 2 at 10.4% of the count, and California number 3 at 10.2%. Then we look at Arizona number 4 at 4.7, then Georgia North Carolina just a little behind that, Georgia at number 6. And then we have Washington State, my old home state. I now live in Florida, at number 7, Oregon at number 8, New York at number 9, and Tennessee at number 10 with 2.4% of the notes created based on count. And they just inched out Pennsylvania, who was 10 last year, now fell into 11th spot. So we can see how other notes stack up. This list is starting with the most and then in descending order. So we'll skip down past there. The top 10 we already talked about. Then comes in Pennsylvania, Colorado, South Carolina, Idaho, Utah, Ohio, Missouri, New Jersey, Nevada, Oklahoma, Alabama, Maryland, Indiana, Montana, Virginia, and Illinois. And then we start getting into the other group of states. And so if you want to see exactly where each state was listed on there, I do make these slides available over at noteinvestor.com, and you can download them and study them carefully. We also look at types of note creators. So we look at the multi-note creator, the pros. This is a seller who owned the property, took back financing using a seller carry or an installment sale, and they did that 2 or more times in a 12-month period. And then we have the single note creators. We call those mom and pop. They just took back 1 note in the last 12 months. So we can see on the top there, the green, those are the multi-note creators. In 2019, they made up 4% of the sellers overall, but 13% of the notes created. It makes sense they're doing multiple notes, so they make up more of the volume of notes created, even though they're a smaller number of all the sellers. So they were a 13% of the notes created, and those single note creators made up 87% of the notes created. So we can see those numbers kind of bump up and down. We also like to track that because in 2014, the Dodd-Frank Act was implemented, and some, not all seller financing transactions come under that. Some are exempt, some are not. But there's definitely some differentiation between these professional sellers and how they have to comply with the ability to repay. And it took us some time to figure all of that out. A lot of people now use, if they're doing multiple notes, use an MLO, a mortgage loan originator that understands seller financing to make sure they qualify under that Dodd-Frank Act. So we have some good solutions to that now in the owner financing world. So now we talked about 2019, and those numbers come out usually about April, May of every year, because it takes some time to compile all that data from all those counties and all those states, because there's some lag time. So when all this was happening and we're releasing these, guess what's going on? The coronavirus, COVID-19. So things have really changed in 2020 already. So I always like to ask Scott, who compiles this data at Advanced Seller Data Services, to give us his opinions. And also I like to weigh in based on my 30 years of experience of where I see the next year coming as well. So this next couple of slides are as a quote from Scott, and he said, "I believe this pandemic will greatly impact our market. It will not be possible to project trends for 2020 based on last year, 2019. The number of records we collected the third week of March dropped to 40% of counts from the third week in February. We are currently collecting about 30% of normal. That drop in numbers is due to counties temporarily stopping data collection. So a lot of counties even closed or weren't doing recordings, or slowing home sales because sales weren't going through. When the March and April sales numbers are available, we can project seller carry notes will see a similar decline for now. So as slowing home sales go down, it's seller carry notes go down as well. The remaining gap are records we have not been able to access yet. But here comes the big part. We saw a similar drop in note creation between 2008 and 2009, followed by a doubling of notes created between 2010 and 2014. Unfortunately, record numbers of people are being furloughed from their employment. Many will suffer damaged credit because they can't make their payments, right? Even when they are normally responsible borrowers. If they can't qualify for a bank loan, or if the housing market softens significantly, history indicates we will see a flood of new notes. And I agree with that. When we look at what happened after the 2008, I think we're going to see a similar increase of seller finance notes created. And why is that? Let's look at the reasons. Well, it's harder to qualify for traditional loans. I mean, this happened right away. We saw Chase went to a 700 minimum score for a traditional bank loan on a home and required 20% down. That's up from just requiring 3.5% down. We saw Wells Fargo and US Bank raise their scores to 680 when they were below, looking at below 600 scores sometimes. Credit supply fell 16% in March alone. That's the lowest it's been since June of 2015. And MBA, the Mortgage Bankers Association's vice president, said this. He said there was a reduction in the availability of loans with lower credit scores and higher LTV ratios. And the largest pullback came from the jumbo, the big loans, and the non-QM space, QM standing for qualified mortgage. So the non-QM space a lot of times has to do with notes or loans that are under that $150,000 because the costs, when you compare it to the loan, sometimes it makes it prohibitive for them to do that under what's called a qualified mortgage. And that's where we see a lot of seller financing, is that properties under $150,000. Now we see obviously more than that too, because remember the average residential loan balance was in that $190,000. But just know that non-QM space, there is a lot of seller financing, and that pretty much dried up right away. Another thing we saw happen right away, and normally when we see some delinquencies or non-performing, we see it kind of inch up over a year. But because so many people were laid off right away, and because so many banks started talking about forbearance or forgiving some payments, we saw residential home loans delinquencies go up right away. So this quote comes from Fannie Mae. They said that, and they underwrite those traditional bank loans, right, through the banks. They said that They estimate approximately 7% of their loans on single-family homes have taken forbearance so far, and their allowance in the quarter reflects an uptake of 15%. So they say they haven't even seen all of those in forbearance that they think are going to. So a lot of people are asking for forgiveness of those payments and having them tacked on the end. So we foresee there will be also a rise in non-performing notes that come on the market, either sellers who want to sell because they need to or because maybe the note's not performing, or down the road, banks who have some book of inventory that they will want to sell. That'll take some longer time to hit the market. Seller finance notes, we're seeing, of course, delinquencies there like we're seeing in residential notes. I thought it was interesting, FNAC, First National Acceptance, who has been buying seller finance notes for over 45 years, said they traditionally see about 23% of mortgages they purchased go at least 60 days past due, and during a recession those numbers will likely increase. So everybody's book of business can look different. My experience with the seller finance notes I bought have not been that high of delinquency. Fortunately, the ones I own in my IRA right now, they're still paying timely. Now that as we go into May and June, if the economy doesn't get back on track, we could see differences. So everybody's book of business might be different, but one area we know it's definitely going to get hit is this commercial note area. Fitch, who tracks these numbers, traditionally just an all commercial, said, not just owner financing, but in general, expects the hotel and retail delinquency rates will increase to approximately 30% and 20% respectively in the near term, up from 1.44 and 3.51 in March of 2020. Both those projected rates will surpass their prior peaks of 21% and 7.67%. So we're talking about, they think hotel delinquency on mortgages will go up 30% and retail up to 20%. And that makes sense, right? Because there's nobody traveling, and when all these stay-at-home orders were happening, there was nobody shopping as well. So you're going to see a lot of commercial notes have a rise in delinquency as well. And we think those values will really get hit in that area as well. So we hear these numbers and we think, well, does that mean it's not a good time to be in the note business? Well, what are investors doing? What are people who buy, institutions and individuals, private individuals, what are they doing that are buy these notes? It's because we buy these notes at a discount. Well, the good news is cost of funds are still low, especially if you've got institutional money. We know the Fed, what they've done, they've lowered the interest rate. So cost of funds are still low. So pricing is based sometimes on yield and sometimes on exposure, investment to value, ITV. So when pricing is based on yield, those kinds of deals that have good equity in them and are mostly based on yield, we see that the pricing is still strong and those deals are still getting done. But LTV, loan to value, and ITV, investment to value, really make a difference. They've always made a difference, but especially now they really make a difference. So for example, one investor had said that due to COVID-19, their underwriting guidelines right now is that they want 20% equity, and if the purchaser has a credit score under 600, the file needs to have 30% equity. So we're seeing that people want more equity, and it makes sense because of poor credit score, you want more equity protection in case that note doesn't pay and you have to take the property back. We also see investors being careful in debtor-friendly states, so states that make it harder to foreclose or harder to evict. So those states have traditionally been long foreclosures in places like New York, New Jersey. In some states, they have non-judicial foreclosures, but they're very debtor-friendly. So just here's another example of one investor that announced that they're no longer, for now, considering California, Illinois, Nevada, New Jersey, New York, Ohio, or Washington. So, the investors get to make their own decision. This is not across the board, but this is, because of concerns of either values in those areas or how long it might take to foreclose or to enforce a note if they quit paying. We're also seeing that new notes, so newly created notes, are reviewed carefully. So usually you can sell a seller finance note after it's had just one payment made, but always those notes are looked at with more stringent underwriting because they don't have a long-term payment history. But we're seeing that even more so now, and that makes sense because we want to know if people are able to stay employed and make their payments. We're seeing more payer interviews and really making sure the employment status and how stable that is. We're seeing needing proof of last payment to make sure that the notes are really current, or if they're not current, they're priced accordingly. And we see investors being very careful watching property values, because you might think you're at an 80% or 70% loan to value, but if those property values go down, then you want to also be reducing your exposure. We also know projections for post-COVID investing that there are going to be more seller finance note holders that will want or need to sell. So when the economy is good, sometimes they'll hang on to those notes. They might sell them if they have another investment. But when the economy gets tough, a lot of times they'll sell those notes because they need the cash flow. We also see more seller finance notes are going to be created. Once we get through this time when it's hard to show houses and people get back out buying houses, it's going to be harder for people to get loans through banks, and we see that there'll be more seller finance notes created. We also believe there'll be more partial purchases structured, because as investors want to lower their investment to value, or if they think a deal might be a little bit risky, they can do that by just buying, say, the next 5 years or 10 years of payments, and as long as those come in good, they can look at buying some more. There's going to be an increased demand for professionals knowing how to create notes for resale. So one of the things that I just had released this spring was the Creating Notes Masterclass. So people always say, well, what's the best credit score? What's the best down payment? What kind of interest rate? What kind of term? How much will a note investor buy my note for? What are they considered? What do I need to do to qualify with Dodd-Frank? How do I work with an MLO that understands seller financing? So those are all valuable skills, and that's something that we cover in depth in the Creating Notes Masterclass. And our goal is to create notes with seller financing safely, ethically, and profitably. So I hope you enjoyed this look at 2019 and some projections for 2020. I hope everyone is staying safe and healthy. This is an unprecedented time we're in. And so we will be available here, to help people through seller finance or people who need to sell their notes. If you have questions or you want more information, you can go to my website, noteinvestor.com. You'll see a blog post there with this information in a way that you can download these slides. You can also email me, Tracy@noteinvestor.com. So thanks for attending today, and happy note investing.